Hello, everyone, and welcome back to the channel. This is Fair Value Finder, and today we are taking a look at Airbnb Incorporated, ticker ABNB. We're going to see what the fair value is right now and the growth prospects for the stock. Try and put together a thesis to see where this thing might be going in the next 3 and 5 years. To start, I'm coming up with the fair value just shy of 128.5. Currently, it's trading for 158.37, and discounted cash flows coming in around 138.5. 130 to 140 looks to be about where the numbers are pointing. Earnings yield, it's not bad, but we'd really like to see them coming in with an EPS of $7.92 for the price that they're currently trading at. And 2023 was very good, $7.52. But analysts are projecting a pretty big drop this year down to $4.36 and then a $4.99 the next year, which would put this $7.92 pretty far out in the distance. Well, we'll have to see how things actually play out. Cash flow yield, 39.2, on average 24.7. They just had an incredible 2023, and it does kind of mess with the numbers a little bit, so we'll definitely touch on all of that. They don't pay a dividend. ROE looks really good, 58.7. The debt to equity is not too bad, 1.53. We like it under 1, but we've definitely seen larger numbers here. And this return on equity might be diluted, but that's not bad. And ROA is really good too. So their assets are making them quite a bit of money, 23.21% ROI, some poor investments over the last year. Gross margin, I think this is one of the highest that I've seen, almost 83%, typically around 80. So they're coming in right as they usually do. The net is all over the place though. This last year, they came in with a net of 48.3. Typically, they're around a negative of negative 17.7. They only actually went positive in 2022. So, their revenues have some decent growth. Their net profit and EBIT have come quite a ways from where they started out in 2020. And that's why we're seeing that number. So for our thesis, revenue growth, analysts tend to agree 11.8% for both the 1 and the 2 year. So we'll see if they can stick that out for the next 3 to 5 years. Share count, I'd like to see them hold it flat. They didn't issue a whole lot of shares last year. And with the strong cash flows and actually showing a profit, they could probably hold off on issuing shares as long as their operations are under control. Cash flows, they had a very good year for their cash flows. 25% is really good too. So just a 2% gain year over year would keep them right about their average. We could up this a little bit and say that they do see some pretty good gains in those cash flows. I don't want to go too crazy with it because I want a realistic case here. Assets, slowing down on the growth. If they continue on the trend that they're on, they're down to 5% this next year. Liabilities slowing down as well. Again, continuing on the trend, they're down to 3% growth. And it's good that we see assets outpacing liabilities in growth. Dividend is non-existent. And margins, they had insane margins this last year. They only have 2 years of profit, so there's not a whole lot for us to look at. 2022, 22.5%. 2023, 48.3%. So do I think that they're going to continue climbing from here? No. I think that they just had an exceptional year, and it's probably going to come back down somewhere in the 20 to 30 range. I'd like to see it come down at a slower rate or level out at some point in the 30s, but we will have to see how everything plays out. At this 10% per year loss in their margins, they come down to 28.5% in 5 years, which is pretty reasonable. A lot of companies that we see have 10% net margins total, but they aren't pulling in gross margins of 80%. There's likely work that they can do to keep these high, but I don't think it's going to go over 50%. That's more than a gross margin for most companies. And all of that, as our thesis, gives us this scenario here. So if we're buying at today's prices, what can we expect? Some growth going forward at 12.07% annual growth in the fair value of the stock based on this thesis. We'd be looking at a 3-year value of 171, so $13.50 gain or so. And in 5 years, 177.5, 19.21% gain. And the gain is slowing over time because of these margins. So you're starting out with massive growth and then slowing down with how the math works out. Smooth it out a little bit more. This isn't a completely unreasonable case with a 5% loss. We're looking quite a bit better even at today's prices. And you're looking at an average annual return of almost 18%. So if they can come in with higher cash flows and margins, we can definitely find a reasonable scenario right here. This thesis would give us returns in line with the market over the course of the next 3 years. So the revenue growth that analysts are projecting, no change in the share count, 5% cash flow growth, 5% asset growth, 3% liability growth, and then margins decreasing by 4% annually down to just shy of 40%. This is a pretty reasonable case. If this is what you think is going to happen, now might not be a bad time to buy. Personally, I, of course, am going to want to get closer to the fair value that I calculate because I want market-beating returns. I just don't want returns in line with the market. And if I can get in at my fair value and that scenario happens, then I'm doubling my position, or I'm doubling market returns in the next 3 years and not quite in the next 5. It's slowing down because of those negative margins, but they had such an exceptional year. It's not going to hold or grow, most likely. So if we just take a quick look at all of the valuation metrics graphed, we see that the earnings have come back from being negative and are settling out going forward into a pretty good linear path. Everything seems to be going into a nice little linear path going forward. The balance sheet is the lowest thing here. They have quite a bit of liabilities, a 1.5 debt to equity ratio. And then it's all being led, at least next year, by the earnings. Currently, it's being led by the share price, which is above all the valuation metrics. But as with most growth stocks, this thing's trading out at its 2, 3, maybe even 5-year valuations because there's a lot of growth baked in by the market. Everyone's expecting market outperformance. So I want to thank you guys for watching this one. Please like if you enjoyed the video, comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.